Hey everyone, and welcome back. Today we're diving deep into, the world of passive income,
Passive income.
but specifically through long-term stock investments.
Okay.
And we're going to be focusing on these really incredible Dividend Kings. Have you heard of these?
Yeah.
Companies that have been paying and raising their dividends for over 50 years.
Just impressive, yeah.
Talk about consistency, right?
Yeah.
So we have a great Motley Fool article
Yeah.
that we're going to be using as our guide today. And they really make a strong case for Johnson and Johnson or J&J and Abbott Laboratories.
Yeah, these companies are practically royalty in the stock market. I mean, that kind of track record, it speaks volumes about their commitment to shareholders, giving back, and their stability. It really sets them apart.
Yeah. Okay, so let's unpack this a little bit. Why are dividends so attractive, especially in times like these, when you know the economy feels a bit shaky?
Well, imagine this. You get a paycheck from your investments, no matter what's happening in the stock market. That's the beauty of dividends. This consistent income stream that's not really tied to those daily market fluctuations. It's like a safety net for your portfolio.
Okay.
Offers a sense of security, and that can be really valuable in uncertain times.
I love that, a safety net.
Yeah.
Especially for someone looking for reliable passive income. Now, the Motley Fool article really highlights Johnson and Johnson. And they have an incredible 60-plus year history of increasing these dividends.
Yeah.
And that says to me they're serious about rewarding their investors.
Absolutely. And they're not just resting on their laurels. J&J is currently offering a $4.96 annual dividend per share. That translates to a 3.1% yield.
Right.
Now, just to put that in perspective, the average yield for the S&P 500 hovers around 1.3%.
Oh, wow. That's a pretty big difference.
Yeah, so J&J is really outperforming the market.
Okay. So it seems like they're not just, resting on their reputation either, right? They've been making some strategic moves.
Yeah, you're right. They recently spun off their consumer health division to sharpen their focus on high-growth areas, like pharmaceuticals and medical devices.
Smart.
Yeah, and to back this up, they just acquired Abiomed. They specialize in cutting-edge heart recovery tech.
Wow.
I mean, these actions really showcase their commitment to innovation and future growth, which is essential for any company that wants to maintain those dividend payments over the long haul.
It's like they're saying, we're not just going to sit here. We're going to actively look for ways to thrive and grow.
Exactly.
And the article pointed out that their innovative medicine and medtech units are already seeing strong sales growth.
Yeah.
In fact, the innovative medicine unit brought in over $14 billion in sales for 2 quarters in a row. So it looks like their strategy is working.
It certainly seems that way. And now when we look at their price to earnings ratio or PE ratio,
Okay.
for J&J, it's currently at 15.
Now, hold on. For those of us who aren't financial experts, can you break down what a PE ratio is and why it's important?
Sure. The PE ratio basically tells us how much investors are willing to pay for every dollar of a company's earnings.
Okay.
So a lower PE ratio can sometimes indicate that a stock is undervalued,
Okay.
especially compared to its peers or its potential for growth.
Yeah.
So in J&J's case, a PE of 15 suggests that it might be attractively valued right now, especially with their track record and future prospects.
That makes sense. So J&J is looking pretty strong commitment to those dividends, focus on high growth areas and a potentially attractive valuation.
Good.
What about Abbott Laboratories? They're another one of these dividend kings, right?
Absolutely. Abbott boasts over 50 years of consecutive dividend increases, very similar to J&J. And here's what's interesting. They have a strong free cash flow of over $6.4 billion,
Okay.
suggesting they have the financial strength to continue those dividends.
Now, what exactly is free cash flow? Because it sounds important, but I don't know if I've really grasped it.
Think of it as the money a company has left over. After paying all its essential operating expenses and capital expenditures, it's the cash they can use to reinvest in the business, pay down debt, buy back shares, or pay dividends. Strong free cash flow is really important for a company's ability to sustain its dividend program. So in Abbott's case, it shows us they're generating plenty of cash to cover those payouts comfortably and still have room to invest in growth.
Okay. That is reassuring for someone looking for that consistent passive income. The Motley Fool article really emphasized Abbott's diverse business model as well. What's the significance of that?
That's a great point. Abbott doesn't put all its eggs in one basket.
Okay.
It has a strong presence in several key healthcare segments: medical devices, diagnostics, nutrition, and established pharmaceuticals.
Okay.
So this kind of diversification helps them weather those changing market dynamics.
So it's like having a well-rounded team where everyone contributes, even if one person is having an off day.
Exactly. The article gives a perfect example. Remember how their diagnostics business was hit by declining COVID testing sales? Well, that dip was offset by strong growth in their medical device segment.
Okay, that's diversification in action.
So it's like a built-in safety net for your investment. If one area is underperforming, the others can pick up the slack and keep those dividends flowing, which is really important for someone who wants a steady, passive income stream.
Absolutely. And it's not just about playing defense. Abbott is actively pursuing growth opportunities. They're launching new products like the Lingo glucose monitoring system. They also announced a share repurchase program for up to $7 billion.
Right.
So these moves suggest that they are confident about their future and are committed to delivering value to their shareholders.
So they're not just hoarding cash, they're actively investing in the future. That's great to hear. But what about their valuation? You mentioned J&J's PE ratio. What about Abbott's?
Abbott's is currently around 25,
Okay.
which is higher than J&J's. But remember, PE ratios should always be considered in context. You have to look at the company's industry, their growth prospects, and their overall financial health.
So while Abbott's PE ratio might not be super low, it makes sense when you look at their history of success, their diverse business model, and their commitment to shareholder-friendly actions like dividends and share buybacks.
So it's about looking at the big picture, not just focusing on one number. It seems like both J&J and Abbott are making some compelling moves, both for business growth and for their shareholders. This is fascinating. But I'm curious, for someone like me trying to build passive income through dividends, what are some key takeaways from all of this?
Well, the key takeaway is this. Dividend investing is about more than just chasing the highest yield. You need to look for companies that have a proven track record of dividend growth, financial stability, and commitment to creating long-term value for their shareholders.
Okay.
It's about understanding why those dividends exist in the first place and what makes them sustainable over time.
So look beyond the immediate payout and consider the company's overall health and future. Kind of like choosing a life partner.
Right. You want someone who's going to be there for you in the long run. And that's why J&J and Abbott, with their long histories of dividend growth and strategic moves to ensure future success, are presented as such strong options. They're not just paying dividends, they're building businesses that can sustain and potentially even increase those payouts for years to come.
That makes a lot of sense. Find companies that can keep those paychecks coming in year after year, even when the market is going up and down. But you know what else struck me about Abbott in particular?
What's that?
Their diverse approach. It got me thinking, if Abbott uses diversification to weather market storms, maybe we should too.
Okay.
And not just for choosing stocks, but for building our whole portfolio. What do you think?
That's a great point. And a perfect segue to the next part of our deep dive. Let's explore this idea of diversification further. How much weight should it carry in your investment strategy? We'll tackle that and more after this quick break.
So we were talking about how Abbott Laboratories spreads its business across these different healthcare segments. Like they have a team of all-stars, each with their own strengths, ready to step up when needed. But how does that relate to our own investments? Can we use that same principle of diversification to build a stronger portfolio, one that can really weather those market ups and downs?
That is a fantastic question and something every investor should consider. Just like Abbott isn't betting everything on a single product or market,
Right.
you shouldn't put all your eggs in one basket either.
Right?
Diversification is key for managing risk
Okay.
and creating a portfolio that can handle those changing economic conditions.
So diversification is important, but for someone who's maybe new to investing,
Right.
what does that actually look like?
Right.
Is it just buying different stocks or is there more to it?
It's definitely more than just picking random stocks. You want to think about strategically allocating your investments across different things, like asset classes, sectors, and even in geographic regions. For example, instead of putting all your money in stocks, you might consider adding some bonds.
Okay.
Bonds tend to be less volatile than stocks, so they can provide some stability, especially during those market downturns.
So bonds are like the reliable friend who stays calm when things get crazy.
Exactly.
And stocks are more like that adventurous friend who's always up for new things. Exciting, but maybe a bit risky.
That's a perfect analogy. And when we talk about stocks, diversification means investing in different sectors, like healthcare technology, consumer goods, and energy.
I see.
That way, if one sector is having a tough time, you're not overly exposed to that downturn.
So it's like a balanced diet for your investments
Exactly.
instead of just, tech stocks all the time.
Right.
I need some veggies and protein.
Yeah.
Maybe a little dessert.
Exactly. And diversification won't eliminate risk entirely, but it can really help reduce it. It's about spreading your bets, not putting all your hopes on one winning horse.
Okay, that makes sense. But let's bring it back to our main focus. Passive income through dividend stocks.
Right.
How does diversification work with that strategy?
Well, if you're building a passive income stream through dividends, diversification becomes even more important. Remember, the article highlighted Abbott's resilience because of their diverse business model. We can apply that same thinking to our own dividend portfolio.
You mean by investing in companies from different sectors? So not just healthcare dividend kings like J&J and Abbott, but also companies from other sectors with a history of good dividend payments.
Exactly. By spreading your dividend investments across different sectors, you can potentially soften the blow if one company underperforms or if a whole sector faces challenges.
Okay, so let's say I'm excited about healthcare and already have J&J and Abbott. What other sectors might be good for dividend-paying stocks?
That's a great question. And it depends on your risk tolerance and your investment goals. But let's brainstorm a few. The energy sector can be good, especially with the current focus on renewable energy and that transition to a more sustainable future.
Okay.
Real estate investment trusts, or REITs, are another option. They often pay high dividends and can be a way to diversify into real estate without actually owning properties. And then there's always consumer staples.
Okay.
Companies that make things like food, beverages, household products.
Right, the essentials.
Exactly. Those companies tend to be pretty stable even when the economy isn't doing so well because people still need their products.
Right. Well, there's a lot to think about. So building a diversified dividend portfolio is like making a meal plan for my financial future. It's not just about what tastes good, but also about getting all the nutrients I need for the long term.
Exactly. And just like a meal plan, your dividend portfolio needs to be tailored to your specific needs and preferences. It's important to do your research, consider your risk tolerance, and maybe even talk to a financial advisor to make sure your strategy lines up with your goals.
This is so helpful. We've covered J&J and Abbott, these dividend kings with their impressive track records and plans for the future. But we've also gone beyond just individual companies and talked about building a more diverse portfolio for long-term success.
Absolutely. And with that in mind, let's move on to our final thoughts. We've covered a lot of ground, but I want to leave you with some key questions to think about as you continue your exploration of passive income.
Sounds great. What are those questions?
Well, we've talked about Abbott Laboratories diversifying its business across healthcare segments, but we also discussed how you can diversify your own portfolio across different sectors and asset classes. So the challenge is this. How can you apply this concept of diversification in a broader sense? How can you create a more resilient and potentially more rewarding passive income stream over time? What other income-generating assets or strategies could you consider alongside your dividend stocks? That's a great question. It's like we've opened this treasure chest of knowledge about dividend stocks, but now we're realizing there might be even more treasure out there.
Yeah.
This is exciting. But before we get too carried away, let's wrap things up and make sure we've hit all the key points from today's deep dive. All right, so let's recap what we've uncovered in our deep dive into passive income and these incredible Dividend Kings. We started with Johnson & Johnson, a company with an amazing 60-plus year history of dividend increases and a real focus on those high-growth areas in healthcare. Then we moved on to Abbott Laboratories, a company that really impressed me with its diverse business model and their commitment to both dividend growth and innovation.
Yeah, and we didn't just stop at individual companies. We also look at how diversification can be so important in building a portfolio that can handle those market ups and downs. It's about building a solid foundation for your financial future. Yeah, I love that analogy. And speaking of foundations, that Motley Fool article was great, gave us some fantastic insights and a good starting point for our conversation. But it's just the beginning, right? What can our listeners do if they want to learn more about passive income through dividend stocks?
That's right. The Motley Fool is a great resource, but you always want to do your own research. Look at different perspectives before making any investment decisions. Go beyond those headlines. Really dig into a company's financials, their management team, and their long-term strategy.
So don't just take someone's word for it. Do your homework. Make sure you're comfortable with the company and its future. It's your money, after all.
Exactly. And remember, investing is a journey, not a destination. It's about learning, adapting, and continually refining your strategy as you go. If you're feeling lost or unsure, don't be afraid to talk to a financial advisor. They can help you navigate the market and create a plan that works for you.
That's great advice. And as we wrap up this deep dive, I can't help but feel inspired. We started by looking at Dividend Kings, but we discovered so much more. We learned about the power of dividends, the importance of diversification, and why it's so important to take a long-term perspective when it comes to investing.
Absolutely. And that's what I love about these deep dives. We begin with a specific topic, but it often leads us to a much broader understanding of how everything connects. And I hope this deep dive has sparked something in our listeners. A sense of curiosity and a feeling of being in control. Investing doesn't have to be scary or complicated. It can be an exciting way to take charge of your financial future.
And remember that final thought we left you with. Thinking about diversification beyond just stocks, could you explore other income-generating assets, like real estate, or even starting your own side hustle? It's all about finding what works for you and building a financial strategy that gives you confidence and peace of mind.
I like that. Building a diversified portfolio is like building a diversified life. Explore your options, take calculated risks, and ultimately find what brings you both joy and security.
I love that. So as we say goodbye for now, I want to leave our listeners with a sense of possibility. The world of investing is huge and exciting, and there's no single right way to do it. Take what you've learned today, keep exploring, and never stop learning. The best investment you can make is in yourself and your own financial knowledge. Thanks for joining us on this amazing journey. Until next time, happy investing.